So guys, financial reporting basically refers to the way the company show their financial performance to their investors, to their creditors, and to their other stakeholders. And financial performance of a company is measured through three statements. Please understand this. Financial performance is measured through three statements. What are those three statements, guys? The first is your income statement. Income statement is also known as profit and loss account. What does your income statement tell you, please? Guys, any idea what does the income statement tell us?
Revenue and expenses of the organization from
Yes.
operation.
It tells, it shows the revenue and expenses of the company, and it tells us whether the company is making profit or a loss for a given period. Right. So it basically tells whether the company is making a profit. Science students, please pay a lot of attention. This class maybe won't be repeated in the future, but today I'll tell you things in such a way that your mind gets crystal clear with respect to financial accounting. So it basically tells whether company is in profits, or whether the company is making profits or losses for a given period. Right. So this is your income statement. Okay. Next is your balance sheet. BS, balance sheet. What does the balance sheet tell us?
Financial position of the company.
So it basically, in very simple terms, balance sheet shows what the company owns and what it owes. Right. So it
as on a
shows
particular date.
on a given date, as on a as on a particular date. Okay. The next is your cash flow statement. What does the cash flow statement tell you?
Inflow and outflow of cash.
Yes, the cash flow statement will basically show the inflow and outflow of cash. A net cash inflow or a positive cash flow basically means that the company has more cash coming in than going out. And if a company has a if the company has a net cash outflow or negative cash flows, that basically means that the company is, which basically means that more cash is going out than coming in, right? And the cash flow statement helps analyze the liquidity of the company. So the level 1 syllabus basically pertains how to report various line items under income statement, under balance sheet, under cash flow statement. If we are good with that, then we are good with financial accounting, right? So let's discuss the income statement first. Okay. So we have already told you, as I've already told you, that income statement shows the revenue and expenses of the company, and it tells us whether the company is making profits or losses for a given period. So what is revenue, guys? How would you understand revenue?
Sales.
Yes, it's the amount of income generated through sale of goods and services. Please write this down. I won't write this. Please write this down. It's the total amount of income generated by the sale of goods and services. And what is expense? Expense is basically the cost that the company incurs to generate revenue. Please write both, write the definitions of revenue and expense. Revenue is the total amount of income generated by a company by sale of goods and services. Expense is the cost that the company incurs to generate revenue, right? Now, what is the use of income statement? What is the use of income statement?
To see the profitability of the company.
Yes, so investors look at the income statement to value the company, right? Investors would look at the income statement to, I'm writing this down, investors would look at the income statement to value the company. Banks and bondholders would look at the income statement to get an idea of the company's credit worthiness. Right? They would look at the income statement to guess whether the company would be able to repay the loans that the company takes. So they will have an idea with the income statement. Okay. Next is your balance sheet. Cash flow statement I'll explain on some other day. Today I want to keep things as simple as possible. Now, balance sheet is basically a statement of what the company owns and what the company owes at a specific point of time. So, your balance sheet, right? Usually, we prepare the T balance sheet, right? This is your T balance sheet, right? So, it's looking like a T. On the right hand side, you have assets, and on the left hand side, you have liabilities, right? What are assets? Guys, how would you define assets? Now, I don't want a formal definition. I want a very loose definition which one can understand. So, assets are things that have value, right? Things that are valuable and are expected to generate uh, income for the company in the future, right? That is expected to provide benefits to the company in the future. So, please write this down. Assets are things that have value and are expected to generate revenue or benefits to the company in the future, right? You have current assets and you have non-current assets, right? Assets of a company can be classified into current and non-current. Now, how do we classify them? That is for a later day, not today. But basically, your cash, your accounts receivable, your marketable securities, your inventory, all are your current assets. And non-current assets would be building, land, property, plant, and machinery. Right. So these are some of the examples of non-current assets. Then we move to the liability side. We move to the left-hand side. Right. So in the liability side, we report equity and liabilities. Right. So liabilities are basically what? They are basically debt or obligations that the company owes to other entities, right? They are debt or obligations that the company owe to other entities. Now, your liabilities can also be bifurcated into current liabilities and non-current liabilities. Liabilities can be classified into current and non-current. Okay, so what are your current liabilities? Your accounts payable is your current liability, right? And non-current liabilities, so any bonds that you issue, any long-term debt, any bonds, All that stuff is your non-current liabilities. And then we have equity. What is equity? It is the residual interest of the owners of the company. Or equity is basically what remains in the company after liabilities have been paid by selling the assets. Right? So it is the residual interest of the owners of the company. Basically, equity is what remains after paying off the liability by selling the assets. Right? And basically, please write this down. Assets should always equal liabilities plus equity. Assets shall always equal liabilities plus equity. So basically, the total of the liability section or total of the left hand side should equal the total of the right hand side. If this is not the case, then you have missed recording some transaction, right? So then you have made some mistake in reporting a particular transaction. So always this is, please note this down. If the asset and the liability side total are not equal, then you have made a mistake in reporting some transaction. Right? Are we good, guys? बोलो, any doubts? संकोच बोल, कोई डाउट?
गुड सर।
शिवाशीष, कोई डाउट है? मेरा साइंस स्टूडेंट्स, कोई डाउट है? साइंस गाइस? नहीं? संकोच है, शिवाशीष है कि चला गया?
सर पीपीएम क्या था?
हूँ सर।
पीपीएम प्रॉपर्टी प्लांट एंड मशीनरी. शिवाशीष, कोई डाउट है? शिवाशीष,
नहीं सर।
now guys,
नहीं सर, नहीं है डाउट।
okay, now we'll understand how to make a balance sheet or an income statement, balance sheet and income statement from scratch, and I'll tell you how things work. Right? So say you start a company with $100 cash. Right? So you start a company. Guys, is the screen visible to you? Can you see what I am typing in Excel?
Yes, sir.
So I'll explain things from the basic level, because you require basic level in CFA, right? So actually what happens is that CFA does not want you to understand any kind of journal entries, right? There is a concept of journal entries in accounting. Thankfully, CFA does not want you to understand how to write journal entries, right? Or how to make journal entries. So you start a company with dollars 100 cash. Okay. So how will your balance sheet look? So on the right hand side you have assets, on the left hand side you have liabilities. Right, so you start with $100 in cash, right? So on the asset side we'll report a cash balance of $100, right? And basically by contributing this $100 in cash, you become owner of 100% of the equity of the company. So you will record a equity of $100, right? So I'll repeat this again. You started a company with $100 cash. So on the asset side, you report a cash balance of $100. And by contributing this $100 cash, you become owner of 100% of the equity of the company. So we report an equity of $100 on the liability side. Guys, are we good? Guys, are we good or not? Have we understood this? All of us?
गुड
Yes
सर।
or no?
Yes, sir.
Now say
गुड सर।
you take a loan of $100. Now, how will your balance sheet look? So I'll just copy this so that I have to type less. Right, so you take a loan of $100 from a bank. So your debt would increase by the amount borrowed, right? So we'll basically, the amount borrowed would be reported as debt. So we've borrowed $100, so the amount borrowed would be reported as debt. And cash would increase by the amount of debt borrowed. So cash would increase by $100 to $200, right? So basically, cash would increase by the amount borrowed, right? So we borrowed 100. We already had cash of $100. We borrowed another $100 by taking a loan. So cash would become 200. Now you can see that the balance sheet total is tallying up. Okay. The asset side and the liability side total are equal. Any doubts here? Sankosh, Shivashish, कोई doubt है?
No,
नहीं
sir.
सर.
और तो कोई नहीं है ना साइंस से? कोई है साइंस बैकग्राउंड? So guys, first write this down here. Total assets and total liabilities should always be equal. Total assets and total liabilities should always be equal. If not, you have failed to record a transaction. If not, you have made an error in recording the transaction. Please understand this. Total assets should equal total liabilities. If not, you have made a mistake in recording the transaction. Okay, this is the first point. Now write the second point. The second point is that please note every transaction is affecting two accounts. Every transaction is affecting two accounts. Now guys, when you contributed, okay, when you took a loan of $100, right? When you took a loan of $100, it increased your debt by $100 and it increased your cash by $100. So two accounts were getting affected. Please write this down. Every transaction is affecting two accounts. When you took a loan of $100, it increased your cash balance and it increased your debt. So it affected two accounts, right? When you took a loan of $100, it increased your cash balance and it also increased your debt, thus affecting two accounts. This is known as double entry method of bookkeeping. Right? And this double entry method of bookkeeping basically tells you that every transaction will affect two accounts. Please remember this, right? Every transaction would affect two accounts, and this is known as the double entry method of bookkeeping. This is the base of accountancy. This is the very base of accountancy. Right, guys? Are we good? Should I move forward? Guys, should I move forward or not? Any doubts?
Yes, sir. No doubt.
Good sir.
Next thing, please understand. Say what you do is now with your available cash balance, you buy property, plant, and machinery at $75. You buy property, plant, and machinery at $75 by paying cash. Now, how will this impact your balance sheet? Naturally, guys, cash would reduce by the amount paid to buy the property, plant, and machinery. So we've paid 75. So cash would reduce by 75. And guys, PPM, property, plant and machinery, would be recorded at cost price of $75. Okay. So my balance sheet is again tallied. Only cash reduced and we reported property, plant and machinery. Right. So again see, when you bought a property, plant and machinery at $75, it affected two accounts. It affected your cash account and it affected your PPM account. Right. Now let's move forward. Let's move forward. Now the next idea is, guys, you purchased, the company purchased inventory of $25 by paying cash. What is inventory, guys? Any idea what is inventory?
Current assets.
Okay, it's a current asset, but what is inventory? Inventory is basically what a company
Stock.
buys to resell, right? So please write this down. I'm, speaking very basics today. Inventory is what, is basically goods that company buys to resell. Okay. Now, how will we record this transaction? Now, basically, cash would reduce by the amount of, it'll reduce by the amount of cash paid to buy inventory. So our cash balance was 125. We paid $25 in cash to buy inventory. So now our cash balance would reduce by $25 to $100, and we'll report inventory in the balance sheet at cost. So inventory would be reported at cost, which is $25, right? And our balance sheet total is 200, right? So we purchased inventory costing $25 by paying cash, right? So our cash balance would reduce by the amount paid to buy. Just a second. Our cash balance would reduce by the amount paid to buy inventory, and inventory would be reported in the balance sheet at cost, right? Guys, are we good? Any doubts? Should I move forward? Any doubts here, guys?
No, sir.
Okay. Now say, yes, did someone point out anything? PPM, Nana, property, plant and machinery. Next, guys, now you bought this inventory at 25, right? You bought this at 25 and you sell inventory, uh, you sell this inventory that you purchased at 25 at $40. You sell inventory costing $25 at $40. Now out of this $40 sale, 30 was cash sale, and 10 was $10 was credit sale, right? So now we'll have our income statement. Now I'll bring the income statement in picture, right? So we'll use the income statement here. So income statement. So on the right hand side, I am reporting revenue and income. So we'll report a sale of how much, guys? Will we report a sale of $30 or will we report a sale of $40?
40.
Yes. So you'll you'll report a sales of $40. Now, guys, please understand. you are recording the credit sale too as a sale, in spite of the fact that you did not receive any cash against the credit sale. Please write this down. You are recording the credit sale as revenue. You are recording this credit sale as as revenue, in spite of the fact that you have not received any cash against this credit sale. Now this is known as this method of accounting is known as accrual basis of accounting. Please write this down. This method of accounting is known as accrual basis of accounting. And what does the accrual basis of accounting tell you? It tells you that revenues and expenses are recognized when transaction is made. Please write this down. Revenue and expenses are recognized when transaction is made and not when cash is received. Revenue and expenses are recognized when transaction is made and not when cash is received or paid. Right? So any credit sales, any non-cash sales would also be reported as revenue, will also be reported as sales in your income statement. Okay. Now, guys, you sold this inventory that you had purchased, right? So once inventory is sold, its cost is reported as cost of goods sold in the income statement. Please write this down. Once inventory is sold, its cost is reported as cost of goods sold in the income statement. Now COGS stands for cost of goods sold. I'll repeat this. You bought inventory worth 25. Once you sell this inventory, this its cost is reported as COGS in the income statement. Right? So you have sold the inventory at 40, which you bought at 25. So you made a profit. Right? You made a profit of 15. So total of income statement is basically 40. Right? So this is the total. Okay, now how will the balance sheet look like, guys? Now let's start with the asset side. Okay. So guys, cash would increase by the cash sale of $30. Right. So please, we'll increase the cash balance by $30. Why? Because cash would increase by the amount of cash sales. Property, plant and machinery would remain unchanged. Will we report inventory in the balance sheet, guys? Will we report inventory now? Please tell me.
No.
No, because inventory has been sold. We won't report it in the balance sheet any longer. Guys, we will report something called accounts receivable. Basically, accounts receivable records the amount our customers owe us. Right? Please write this. Accounts receivable records the amount our customers owe us. So we made a credit sale of $10. So our customers owe us $10. Right? So we'll report accounts receivable as $10. Right? Now let's go to the liability side. Okay. Guys, I've already told you a number of times that the profit for the year is added to your retained earnings, and retained earnings is a part of shareholder equity. Now we are not reporting retained earnings separately in this balance sheet for the sake of simplicity, quite naturally. So we'll add the profit for the year to my equity. Right? Profit for the year, we'll add it to our equity. though it should be added to retained earnings, but we are not reporting retained earnings separately. Retained earnings is a part of your shareholder equity, so obviously profit for the year would increase your shareholder equity, right? Profit for the year was $15. So your total equity at the end of total equity would now be 100 plus profit for the year, which is 115. So again, our balance sheet has tallied, right? The asset and the liability side are equal, guys. So once your asset and liability side are equal, basically you are rest assured that you have not made a mistake in recording a transaction. Guys, are we good? Any doubts up till now? Sankosh, कोई मन में doubt? Guys, बोलो कोई मन में doubt है
No,
किसी
sir.
को?
No, sir.
Okay, now guys, what happens is that your customer repays you $10. So my cash balance would increase by $10 because my customer has paid me. So he must have paid me in cash. So my cash balance would increase by $10. Right. And accounts receivable would basically be reported at zero, or we'll basically remove it from the balance sheet because our customer does not owe us anything now. Right. He's paid us whatever he owed us. So we won't report accounts receivable anymore in the balance sheet. Right. So my balance sheet has again tallied. So here I'll write this, that our customer repays us $10. Okay. Now guys, the third idea is that you have purchased inventory costing $50 on credit. You have purchased inventory costing $50 on credit. Right. So now see, how will you report this on your balance sheet? This won't go to your income statement because you are not earning or losing anything by this transaction. Right. You are not earning or losing anything by this transaction. Right. This was going in the income statement because by doing this transaction you are basically making a gain, so that is why it was going there, right? This particular transaction, when you sold inventory costing 25 at 40, you made money, and since you made money it went into the income statement. But this particular transaction, that is when you purchase inventory costing $50 on credit, you've not made a gain or a loss, so this is not going to your income statement. This will affect your balance sheet. Okay. So guys, since I have purchased inventory at $50, I will report inventory. Right. I will report inventory at cost in my balance sheet. Okay. And guys, I will record accounts payable. What is accounts payable? Guys?
The money you owe.
Yes, accounts payable, please write down what you owe to your suppliers or your vendors. Right. So you purchased inventory costing $50 on credit. So how much do you owe your credit? How much do you owe your suppliers, or how much do you owe your vendors? Guys, please tell me. How much do you owe them? You purchased inventory costing $50 on credit. You have not paid your suppliers. So how much do you owe them? Please tell me.
$50.
50.
So we'll record $50 as accounts payable. Right, guys. So this is how things work. let me give you another one or two examples. Okay, guys, now you sold this. Out of this $50 inventory, out of this $50 inventory, you know you sold inventory costing $25 at $50 or $40, and out of this $40 sale, $30 was cash and $10 was credit, right? So now you had what? Inventory costing 50. Out of that inventory, you sold inventory costing 25. So basically, you sold half your inventory. Half is sold, half is unsold, right? So you sold your half inventory at 40, and out of this $40 in sales, 30 was cash, 10 was credit, right? So now, will this transaction impact your income statement? Bolo, will this impact your income statement?
Yes. Yes.
Yes, sir.
Yes, this transaction will impact your income statement. So let's copy the income statement. This was my income statement. Okay, so uh, my previous sales were 40. I made fresh sales of 40, right? So my sales would become 40 plus 40, 80. Okay, and we sold fresh goods worth $25, right? We sold fresh goods costing $25. So my COGS would become 25 plus 25, 50. What would be my profit? 80 minus 50, that is 30. So my total profit for the year is 30, right? So this is how my income statement will look, right? Because I sold inventory costing $25 at $40, so I made a profit of $15, right? And my old profit was $15, right? So when I accumulate the profits, my profits become $30. Now let's look at the balance sheet. How will this transaction impact your balance sheet? Okay. First, look at the cash balance. Will there be any impact on the cash balance of the company, guys? Please tell me yes or no.
Yes.
What would be the impact? Cash balance would increase by the amount of cash sales, right? So we had
30.
made a cash sale of $30. So my cash balance would increase by $30, right? Property, plant, and machinery would remain unchanged, right? My inventory, I sold half of the
25.
inventory, half remains unsold, right? So my unsold goods would be recorded as inventory, right? So $25 worth of goods are unsold, right? So I'll write this down. Unsold goods are recorded as inventory, and sold goods are reported as COGS, cost of goods sold, in income statement. Or rather than that, right, cost of unsold goods are recorded as inventory in balance sheet, and cost of sold goods are reported as COGS in the income statement, right? So my inventory is 25, guys, and my customers owe me $10, right? Why my customers owe me $10? Because $10 worth of sales were credit sales. So my Customers owe me $10. So I'll report an accounts receivable of 10. So my asset side total is 290, 280, right? Okay, guys, my profit for the year is now 30, right? So I'll just replace 15 with 30. So guys, you can see that my balance sheet has tallied, right? The asset side and liability side totals are equal, right? Now the last transaction that we will understand is total salary for the year is $10, right? This is what you pay your employees, and out of this $10 salary, $6 is paid in cash, and 4 is unpaid at the end of the year, right? So will this impact our income statement, guys? Will this transaction impact our income statement, guys?
Yes, sir.
No,
Yes,
sir.
it will definitely, because salary is an expense.
The expense.
Salary is an expense. It's an expense to the company. So naturally, we had discussed that both revenues and expenses are reported in the income statement, right? So write this down. Salary is an expense, and both in revenues and expenses are reported in the income statement, right? So this transaction would definitely impact your income statement. So let's restate our income statement. Okay, so we'll record a salary expense of $6, $4, or $10.
10.
10.
10.
10.
Total
Yes.
salary.
So we are
10.
reporting the entire salary as an expense, even though we paid only 6 in cash. Remaining 4 was unpaid, right? In spite of that, we are recording the entire salary as salary expense. Again, this too is an example of accrual method of accounting, right? Expenses are recognized when the transaction is made and not when cash is paid, right? The expense is being recognized in the year the transaction was made and not when the cash was paid. The expense is being recognized in the year in which the transaction was made and not when cash was paid, right? So we'll report a salary expense of 10. My profit would reduce to 20. Okay, and let's look how the balance sheet will look. Okay, guys, cash would reduce by the amount of salaries paid in cash, right? So we paid $6 salary in cash, so cash would reduce by the amount of salaries paid in cash. For ppm remains unaffected, inventory remains unaffected, accounts receivable also remains unaffected. Okay, your profit for the year has become 20, and guys, you will recognize something called salary payable. The $4 unpaid salary is a liability to you which you have to pay in the next year, right? This $4 unpaid salary is a liability to you that would result in an outflow in the next year. So you record it as a liability in your balance sheet, right? So once you record this as a liability, why are we recording this as a liability in your balance sheet? Because this unpaid salary will will result in an outflow in the next year, right? It's an obligation that you owe to your employees. This unpaid salary is an obligation, and any obligation is reported as a liability, right? And this liability would result in an outflow in future years. So, guys, this is the basic idea of accounting. I hope you've understood things. Bolo, guys, have you understood the basic idea? This is the basic idea of financial accounting. This is how you can make income statement and balance sheet from scratch. Are we good, guys? Yes or no? Please tell me.
Yes, sir.
Good.
शिवाशीष समझ में आया तुमको?
Yes, sir.
Okay. So, uh, basically, guys, this is the broad idea. Now, please write this down. There are two methods of accounting. First is accrual, the other is cash. There are two methods of accounting. First is accrual method of accounting, the other is cash method of accounting. Now, what is the accrual basis of accounting? Accrual basis of accounting, revenues and expenses are recognized revenues and expenses are recognized when transaction is paid. When transaction is made, and not when cash is received or paid. And the other branch of accounting is cash basis. Under cash basis of accounting, basically revenue is recognized in your income statement when cash is received, and expense is recognized when cash is paid. Right? So, two bases of accounting: accrual basis, cash basis. Right. Okay. Now, guys, under accrual basis of accounting, so we are more interested with the accrual basis of accounting because it gives a more correct and fair picture of the transactions that have been made in a given a financial year, right? That is why we are more interested in the accrual basis of accounting, right? If we follow the accrual basis of accounting, then only we'll be able to find out the profit for a specific period of time, right? It's only when we follow the accrual basis of accounting will we be able to know what happened during a period of time, right? Because it's recognizing revenues and expenses on the date the transaction was made, right? It's recognizing the revenues and expenses on the date the transaction was made. So it gives us a fair picture of the profit or loss that the company would make in a given time period, right? So that is why we are more interested with accrual basis. Now, see, under accrual basis, revenue is recognized as per the revenue recognition principle. This is very important. And expenses, revenue is recognized using the revenue recognition principle, and expenses are recognized using the matching principle. Very important part. Now, what does the revenue recognition principle say? It basically says is, what it says is that revenue is recognized when sale is made and not when cash is received. So let me explain this in detail. So say you, okay, there is a bakery, right? And October, September, October, November. Now there is a bakery that receives an order for a cake in October, right? It receives an order cake for a cake in September. It receives an order for a cake in September. It delivers the cake in October, and the customer pays the bakery in November. Right? So this is the idea. Bakery receives an order for a cake in September. The bakery delivers the cake in October, and the bakery receives payment from the customer in November. Now, please tell me, uh, in which month will we recognize the sale of cake?
September.
Hmm?
September.
No, we will recognize the sale
October.
when we
You
deliver
deliver.
the goods, when we deliver the cake to our customer, right? So, revenue will be recognized when sale will be recognized in the book when the goods are delivered to the customer. Right? Revenue is recognized when the goods are delivered. So, guys, basically understand, when will you issue an invoice for this cake? When will the bakery issue the invoice? When it receives the order, or when it delivers the cake? When will it?
Delivers.
Hmm? When it
Delivers the
delivers
cake.
the cake, or when it receives the order? It will issue an invoice only when it delivers the cake, right? So revenue is basically recognized when the goods are delivered or when the invoice is issued, right? So we order something from Amazon, right? We order it, say, today, but you know, or not Amazon, say, let's say that we order a machinery, right? We order a machinery. When we order a machinery from a company or from a factory, on the date of order, you know, basically a purchase order would be prepared. Invoice won't be prepared on the date of order, right? When the actual machinery is delivered to us, it's on that day the invoice would be issued, right? So revenue is recognized when the goods are delivered. So in this particular case, the cake is delivered in October, so revenue would be recognized in October, right? It won't be recognized when the order was received. It won't be recognized when the customer paid for the cake. Now let's take another example. September, October, November. The bakery received order in September, and it received the payment also from the customer in October. So basically the customer paid in advance. It The bakery delivered in October. So now tell me, when will revenue be recognized? In September or in October?
October.
Yes, October. Revenue is recognized when the goods are delivered, when the sale is made, not when order is received, not when payment is received. Please write this down. Revenue is recognized. They ask this in the exam. Revenue is recognized when sale is made, that is when goods are delivered, and not when order is received. and not when payment is received, right? So in this case too, revenue would be recognized in October, and the cake is actually delivered. Okay, guys, are we good? So how, we received payment in September? How will we record this advance payment that we've received in our financial statements, guys? How will we record this advance, the
It's a
payment?
liability.
Yes, it's a liability. So in the balance sheet, say the price of the cake is $50, right? So we will record an liability named unearned revenue, right? We'll report a liability termed as unearned revenue, and this liability would be recorded. Um, you know, the amount would be the payment received in advance, right? So since we received the entire $50, which is the price of the cake in advance, we will record a liability of $50 as unearned revenue. Now this is the balance sheet of September. In the income statement of September, no revenue would be recognized, right? Because we've received the order, we've received the payment in advance, but we have not made the delivery till in September. We've not made the delivery in September, so we won't recognize any revenue in September. In October, what will happen is, guys, in October, since in the month of October, when the cake is actually delivered, unearned revenue would be removed from the books. So this $50 would be removed from the balance sheet. Unearned revenue would be removed from the balance sheet, and in the month of October, when the when the cake is actually delivered, we'll recognize revenue at $50, right? So in the month of October, when the cake is actually delivered, unearned revenue would be removed from the balance sheet, and we would recognize a revenue in income statement of $50. $50 was basically the price of the cake, right? So this is how my income statement and balance sheet would look in September and October. In September, when we receive the advance payment, we will recognize an unearned revenue as a liability in the balance sheet in the month of September, and no revenue will be recognized in the month of September in the income statement. Why no revenue will be recognized? Because we have not delivered the cake to the customer in September. In October, we delivered the cake. So since we've delivered the cake, in the balance sheet, we will, in the balance sheet, unearned revenue would be removed, and we would recognize a revenue in the income statement of $50. Right, guys? Are we good? Any doubts here, please? Guys, anyone is having any doubts? Please let me know. Yes or no? Good.
No, sir.
Now, what is the matching principle? Matching principle basically, expenses are recognized as per the matching principle. And matching principle basically says that expenses are recognized in the same period as associated revenues. Right, so it's saying that expenses would be recognized in the same period as associated revenues. So basically what it's saying is that if some goods bought in the current year remain unsold at the end of the year, they are not included in the cost of goods sold for that year. When they are sold in the next year, they will be included in the cost of goods sold for the next year. So I'll explain this with a small example. Right, I'll just explain this with a small example. Okay. So say on 1st November, we purchased 10 books costing 100 rupee each. So our total cost was 1000. And in November, we sold 5 books at 150 each. So our total revenue was 5 into 150, 750. So guys, my total revenue for November is 750. My total cost for November is 1000. So did I just give a loss of $250 or 250 rupees, guys? Did I give a loss of 250 rupees? Please tell me,
No,
guys.
sir.
No,
Sir,
I
but
did not.
you
No.
I did not. I actually made a profit because 5 books are unsold.
Sold. Unsold.
unsold.
5 books are unsold, right? So, you know, the cost of the, so what we'll do in the income statement, obviously, we'll recognize a revenue. Revenue would be basically the price at which we sell that 5 books into the number of books sold, right? And cost of the books sold would be allocated to cost of goods sold. So cost of the sold books is 5 into 100. So we'll recognize a cost of goods sold of 500. My profit would be 750 minus 500, 250. And in the balance sheet, cost of unsold books would be reported as inventory. Cost of the unsold books, which is again 5 into 100, 500. Cost of the unsold books would be reported as inventory in the balance sheet. So in short, what the batching principle states that the company should report an expense in the income statement in the period in which the related revenue was earned. Please write this down. In short, what matching principle is saying that uh, in short, matching principle directs a company to report an expense in the income statement in the period in which related revenues are earned. Okay. Okay. ये क्या हो गया? Okay. Guys, are we good? Any doubts?
No, sir.
Guys, write one thing down as well. There are certain costs that cannot be directly tied to revenues. Certain costs cannot be directly tied to revenues. Your right, certain expenses cannot be directly tied to revenue. So basically, some costs are not related to the production of inventory, right? They cannot be directly tied to revenues. Certain costs are not related to the production of inventory, so they cannot be directly tied to revenues. So such expenses, such costs are expensed in the period in which they are incurred. They are expensed in the period in which they are incurred. Now, these costs are not directly tied to revenue. So they are expensed in the period in which they are incurred, and such costs are known as period costs. These costs are expensed in the period in which they are incurred. They are, these costs are not directly related to or directly tied to revenue. An example of period cost would be your rent, right? Rent of your office, corporate office. It cannot be directly tied to revenue, right? It office rent is not a part of your it's not a cost that is related to the production of inventory. Then your selling, journal and admin expenses, these two are period costs. They cannot be directly related, or they are not you know they are not directly related to the production of inventory. So these costs too are your period costs, and these are expensed in the period in which they are incurred, and not when related revenues is recognized, right? Because these expenses cannot be tied to revenue, because they are not related to the production of inventory. So please note all of this down. I hope you've had a clear understanding of how your income statement and balance sheet is made. For those who are, from the commerce background, I think it would have been a refresher of what they had studied in their undergrad, in their school days, right? So that's about it, guys. That's about it. And
सर स्मॉल डाउट रिसर्च एंड डेवलपमेंट कॉस्ट सर ये मतलब इसको हम लोग मैचिंग कंसेप्ट में नहीं ले सकते राइट बिकॉज इट डजंट
नहीं, देखो,
ऑलवेज
रिसर्च एंड डेवलपमेंट कॉस्ट का ना बहुत अपना एक फंडा होता है, ठीक है ना? उसका एक दैट इज वेरी उसका एक यूएस गैप एंड आईएफआरएस में
हाँ
उसका एक अकाउंटिंग ट्रीटमेंट अलग होता है, ठीक है ना? उसका अकाउंटिंग ट्रीटमेंट ये होता है